I have sold out of my position in APLE, Apple Hospitality REIT, after my Intrendias terminal flashed a sell signal on September 20th when the stock peaked around $16 a share. The Intrendias terminal also has a sell signal for October 23rd. The Intrendias website has been able to navigate through this sideways action since the beginning of 2023. I frequently return back to my website to check on the status of my current positions and watchlist stocks and cryptos. A new buy signal appeared on October 11th. However, I personally have not re-entered because of greater macroeconomic risks that can bleed into Apple Hospitality REITs. The main culprit being bond yields going up, with 10-year US bond yields briefly hitting 5%. First, price pressure. The rising bond yields often lead to lower demand for high-yield dividend stocks, such as REITs. This is because investors may prefer the safety and higher guaranteed returns of bonds when yields increase. As a result, the prices of REIT stocks may come under pressure, leading to a potential decline in their market value. Second, dividend yield comparison. REITs are known for their attractive dividend yields. When bond yields rise, the yield on newly issued bonds become more competitive compared to the dividend yields of existing REIT stocks. Investors seek income may shift their investments towards higher yielding bonds, causing some to sell REITs, which can further impact their stock price. Third, cost of borrowing. To qualify as a REIT, a company must distribute at least 90% of its taxable income to shareholders annually in the form of dividends. Therefore, many REITs rely on debt to finance their real estate acquisitions. When bond yields go up, the cost of borrowing for REITs also increase. This can lead to higher interest expenses, potentially reducing their profitability. Fourth, valuation and discount rates. Higher bond yields can lead to an increase in the discount rates used to value future cash flows from REIT properties. This can result in lower valuation for REITs, impacting their stock prices. And then finally, sector specifics. The impact of rising bond yields can vary depending on the specific type of REIT. For example, interest rate sensitive REITs like mortgage REITs are generally more directly affected by changes in interest rate compared to equity REITs, which own and operate properties. Mortgage REITs' profit can be particularly sensitive to interest rate movements, as higher rates may reduce the value of their mortgage-backed securities. Regarding the hospitality sector, the rising interest rate results in higher mortgage, auto, and other loan rates, leading to greater expenses for customers, tightening their personal spending, and lowers the probability of continued strong travel and vacations. We've experienced airline stocks lower guidance last week in the last week earnings. Perhaps hotel-related businesses will follow suit and continue this downtrend in correlation. Although APLE has been buying hotels and increasing their revenue streams, when the next sell signal appears, which is October 23rd, perhaps puts would be in play as macroeconomic climate worsens for REITs. This has been Intrendias. I hope you enjoyed what we have covered in this episode today. APLE, I personally sold my position out of Apple Hospitality REITs and may consider putting in puts, as the benefit to risk ratio to owning REITs and collecting the dividend versus just getting a high yield 5% US 10 bond is in favor of bonds now. So consider that down the road, not financial advice. I'd love to hear down in the comments below what you think about Apple Hospitality REITs or just REITs in general. Thank you for checking out Intrendias, and I'll see you guys in the next one.